Hi students, so let us study about liquidity ratios. There are two types of liquidity ratios. The first one is current ratio and the second one is quick ratio. Talking about current ratio indicates how many times the company could cover its current liabilities with its current assets. That is whether your company has more current assets to cover all your current liabilities. If yes, then your company is in a good liquid position. But always more current assets does not mean that your company is in a very good state. Because when you're talking about ratio analysis, there can be questions where you have a healthy current ratio, but still you cannot write positively about it. Situations whereby your closing inventory is the highest element in your current asset. Whereby if closing inventory is the highest element in your current asset, it means that your company was not able to make sales properly for the inventory that the company had produced. It was not able to sell all of its inventory. That's why your closing inventory increased, which is an inefficiency. Increase in cash element is good for your company, but not always good. Why? Because if you're talking about increase in cash, it can be due to many reasons. The best reason would be because there was increase in cash sales. Now that is a very good thing. But what if your cash increased due to sale of non-current asset, or due to a rights issue, or a forward issue? Then you have to mention that your liquidity looks high because of a sale of non-current asset or because of a share issue. Okay, so these are the points that you have to take care while you're writing current ratios answer. The same goes with quick ratio, because over here it indicates how many times the company could cover its current liabilities with its current assets, excluding inventory. So you took off inventory from it. So if your closing inventory was higher, it wouldn't have affected your quick ratio. So you cannot compare that point which you took up in current ratio, telling that okay, closing inventory is high, that's why this is not good. Over here you have to only talk about elements except inventory. So over here you have to look into whether your cash has increased or your receivables have increased. And if your cash has increased, again the same thing. If it is due to cash sales, then it is a very good thing. But if it is due to the other reasons like sale of non-current asset or share issue, then you have to mention that, stating that over here we can find that our current ratio is high. This may be due to the increase in cash, that is due to the sale of non-current asset or due to the share issue. So you have to mention this thing while writing your ratio analysis. So these are the points that you have to take care while looking into your liquidity ratios. So first point is that whenever your liquidity ratios is high, you seem to write a good, you seem to say that the company is much more liquid or is performing well, or its liquidity position is good. But it is not always the case. So always check out for three elements. Whether when it is current ratio, whether your current assets are high due to higher closing inventory, or whether it is due to high cash due to which sale of non-current asset or share issue. The same in quick ratio also, but there is no inventory, so we have to only check whether your cash increase is due to what you say, it is due to share issue or it is due to sale of non-current asset. If this is not the case, then you can always say that you have a healthy liquidity. Okay, that's it guys.